What happens if Drive Wealth shuts down? What happens if Vested shuts down? What happens to my money then? Do I lose it? What happens to it? Explain it, please. Hi everyone, welcome to today's video. So today's video is very interesting from the point of view that over the last few months, I have been making a lot of investments outside India. And every time I have shown live investing videos, I get questions like that Akshat, I'm investing outside India with you, but are my stocks safe? Do I even own them? What happens if the app through which I'm making investment, if it shuts down, what happens to my money then? Will I be getting it? Is it insured? Is it not insured? So we will understand the basics of US stock investing today. Please don't drop off. This is a very important video because investing is all about creating a well diversified portfolio, especially from a retail investor point of view. I am a big believer in India's growth story. Majority of my investments will be in India and will continue to stay in India. But having said this, from a diversification point of view, it is extremely critical for me to take some positions outside India. So I'm going to cover that basic perspective. I will speak in 5 simple points. If you are a beginner, this is a must watch video for you so that you can explore the path of investing outside India in a more systematic manner. Right. So, point number one that you need to understand about investing outside India is the concept of sovereign risk and hedging. So, what is sovereign risk? Let us understand by some contemporary examples that are playing out. You must have read about Turkey's economy and how it is getting shattered with every single day. In the last month alone, Turkish lira, which is the standard currency in Turkey, that has lost approximately 30 to 50% of its value in just one single month. Last year, the exact same case played out in country called as Lebanon. Again, locals out there, they lost significant part of their savings because of the sovereign risk. Sovereign risk, in simple words, means the state risk or the nation's risk. Right now, Pakistan is also going through a similar currency crisis, so to say. The rate of inflation there is just skyrocketing every single month. And it looks like that Pakistan is again going to go into a bad state of economic affairs. So every country has a certain sovereign risk. India too has a sovereign risk. Is the condition as bad as Pakistan? Absolutely no. We are a much stable, much more sensible economy from that perspective. But having said this, there have been enough historic cases. Lebanon, Turkey, very recently. You have Sri Lanka that went through a financial crisis. Few years ago, you had Venezuela, Mexico that went through these series of defaults, currency crisis, where bad stuff happened in the economy. And as a result, if you're a hardworking citizen, if you have saved and invested a lot of money in your local currency or local stocks, your entire savings have the potential to get wiped out. That is what sovereign risk means. Now you say, Akshat, if we go outside India, does this sovereign risk goes down? For example, if you are going and investing in European markets, or if you are going and investing in Chinese or the US markets, does the sovereign risk goes down? My answer to that from a macroeconomic viewpoint is yes. To a certain extent, the sovereign risk definitely goes down if you are going and investing in a much more stronger economy. Let's understand this from an example again. For example, if you're going and investing in the US, then what happens? US is a much more stronger economy compared to India. You must have observed two specific phenomena play out. First is the depreciation of rupees vis-a-vis US dollars. Here is a chart for you. You can take a look at the entire 10-year window. You can clearly see that the US is getting stronger on year-to-year basis. But this is just half the picture because you also need to take a look at the inflation data and then superimpose it. But let's not make it complicated. In simple terms, INR is losing value compared to US dollars. So that is the first sign of a weakening economy, so to say, ceteris paribus, keeping other things equal. Second key point that you must have observed about India versus US from an economic standpoint is that very recently when 2020 COVID hit, US printed more money or US injected more money into the economy compared to Indian economy. India was much more sensible in terms of how it released a ton of money into the economy. US was very loose handed with how much money it released into the economy. Why does that matter? That matters a lot because it tells you that, you know what, US can come in and act in a very high handed manner. It can come and release a lot of money into the economy. Even then, their economy will not get destabilized. On the flip side, countries like India have higher sovereign risk. And if they start taking steps exactly like the US, then our economy can derail. That's a sign of a weaker economy compared to the US. These are some basic macroeconomic things that you need to understand, and therefore you must consider investing outside India also. Let me further build upon this point that people say that, you know what, you must diversify your investments outside India because diversification is good. I agree, that is one part of the equation. According to me, that is not the most critical reason why you should invest outside India. You must invest outside India because number one, sovereign risk is very, very high for a country like India, and that is one of the macro reasons why you must invest. Second reason why you must consider investing outside India is because there are certain type of businesses that are coming up that will define the next generation of businesses. Let's talk about through a few quick examples. First, talk about the RPA trend. I have made a separate video on that. You can watch it. RPA is going to redefine how workforces are created. In simple terms, what is an RPA? RPA are smart customized softwares that are going to replace human beings. An example here would be accounting firms. Now, accountants do a lot of repetitive tasks. If you can create a customized software that can automate a lot of work that accountants do in terms of tax filing and bunch of different things, that's RPA at play. It is disrupting jobs in the economy. Now, which is the biggest RPA firm in India? Let me know in the comment box and compare it to the size of the biggest RPA firm in the world. That's one key trend that is anyways coming up, and you don't have major investment opportunities in India from that perspective. So you by default have to go outside India to take bets on that. In India, for example, if you talk about cryptocurrency related businesses, India is a very, very nascent market. We have not even clarified regulations. People are not taking that much bets on cryptocurrencies from that perspective. On the flip side, you have exchanges like Binance, Coinbase. They have grown to become so big. Now, going forward, if the Indian government says that, you know what, cryptocurrency is good, we are very pro to cryptocurrencies, then what happens? We have lost a lot of time in terms of engaging in that race because Binance, Coinbase has become really, really big from that perspective. So what am I trying to tell you is that there are a bunch of trends that are going on that will define in the next 10, 15 years, or probably even in the next 5 years, the next Google, next Facebook, next Netflix. And these companies are not there in India yet. So if you as an investor want to invest in these growing trends, then you need to go outside India. Now, this brings me to part 2 and the second key point that I want to discuss. If you believe in the argument, Akshat, fine, we understand that sovereign risk with India, great investment opportunities outside India, but which countries should I consider? Should I go to China? Should I go to US? Should I go to Europe? What should I do? And what are some of the key things that I need to keep in mind? First and foremost, you must look at the ease of investing. For example, I love the Chinese market. I don't love China, but I love the investment opportunities that are there in China. But for me, as an Indian investor, it is very difficult for me to go and invest directly in China. It is just really, really tough. That's part A. Second, you need to understand how transparent the international markets are. For example, again, let's use the example of China. Now, China, the reports, the audited data, the business data that you get on different companies, we can't be sure that that data is transparent or not. What kind of accounting standards they are following, we don't know. And therefore, as normal retail investors, China might grow at a massive pace, but the ease of investing and the transparency of data becomes a big question mark for us to go and invest there. On the flip side, if you go and try to understand, hey, can I go and invest in the US? Yes, because the ease of investing is fairly simple. It's easy, it's standardized. There is no problem in terms of investing. Data is very clean, it's accounted, it's very well audited from that perspective. So therefore, if you compare US with China, I would say that, hey, as normal retail investor sitting in India, if you want to take bets on international markets, you should go with US compared to China. What about Europe, Canada, a bunch of different countries? Again, I have explained a spectrum, US on one side, China on the other side. US, Canada will fall somewhere along this spectrum, and you need to pick your bets accordingly as per what markets you understand. My simple advice here would be that you should, especially when you're starting, you must start by taking positions in markets that you understand. For example, US market is simpler for us to understand because we consume things like McDonald's. Easy for us, right? P&G, we understand. Unilever, Hindustan Unilever, we are consumers of those products. So as Indians, we have exposure to US more compared to other businesses which are present across different countries. So if you're looking to invest in one country outside India, it should be by default US. This brings us to the third point, that how easy is it for us to go and invest in the US? By us, I mean Indians to go and invest in the US. Is it even legal? So this is the paragraph that you need to read. I will flash it here. It says that under the LRS, which is Liberalized Remittance Scheme, an Indian resident can send up to $250,000 abroad annually without seeking approval from RBI. The LRS has made it easier for Indian residents to study, travel, and make investments in other countries. So, as Indians, we can invest up to 1.8, 1.9 CR because that is what $250,000 of investment translates to. So, we can definitely make these investments. There is no legal risk from that perspective. In fact, you can even invest higher amounts, but you need to take permission from RBI to do that. But as normal retail investors, I would assume that this is the max that we are going to invest outside India in 1 year. Now, this is just one part of the equation that, okay, hey, great, I can invest 250,000 US dollars. But how easy is it? Do I need to physically go to the US to open my Zerotha type of account? The answer is no. I use an app called as Vested for making US based investments. I've been using it for some months and it's an excellent app in my opinion. It's very safe as well. Similarly, there are a bunch of other applications that you can explore. You can use your Indian documentation, for example, Aadhaar, PAN card, etc. to open up your Vested account or any other app that you're using. And you can start buying US stocks directly and US ETFs, which are exchange traded funds. This leads us to the fourth point that, hey, how safe are these apps? What happens if they shut down? Do I lose my money? What exactly do these apps do? So I think we can break apart this topic into series of short Q&As. So let us first understand that what exactly are these apps? So let me take the example of Vested here. So they are investment advisor firms which are SEC registered. So SEC means Securities and Exchange Commission. In India, we have SEBI. Similarly, in the US, we have SEC. So if you go on SEC's website, and here you can check the registration of Vested. Its name is registered at Vested, Vested Finance Inc. And here is the entire registration certificate. It's an investment advisor firm. So this is what these apps are like, that they are investment advisors which are registered with SEC in the US. Which brings us to a related question that, hey, if I'm buying a stock from Vested, what happens to my stock? Do I own it? Someone else owns it? How am I able to do fractional buying? Different subtopics. So let's break it apart. Now, first and foremost, when you are purchasing stocks in the US, it does not come into your Demat account. Unlike that in India, that is a general process, general rule in the US. The stocks that you're purchasing, you will have to purchase it through the broker and the broker keeps your share. That's a very important point. It's not as if that this is Vested's fault or some app that you're using. It's their fault. According to US market regulations, whenever you are purchasing US related securities, your broker will keep it, right? So let me read this statement with you. Share ownership verifications work slightly differently in India than in the US. Shares are held by a third-party custodian in the street name of the broker rather than the underlying investor. That is why you do not receive direct emails from the custodian regarding your holding. As per SEC guidelines, if you want to confirm the share ownership of your Vested account, you can contact Drive Wealth. Now you'll say, Akshat, what is this Drive Wealth? Drive Wealth is a US broker and Vested is an investment advisor. So through this network, when you buy a stock in the US, Drive Wealth is buying stocks on your behalf and keeping it in its own account. Is it safe? Yes, it is safe because Drive Wealth is also registered with SEC, similar to how Vested is registered with SEC. Now comes the most fundamental question that, hey Akshat, what happens if Drive Wealth shuts down? What happens if Vested shuts down? What happens to my money then? Do I lose it? What happens to it? Explain it, please. Okay, so this is a very important paragraph that you need to read. Your assets are held at a third-party custodian and Vested does not touch it or hold your money. If Vested shuts down, you would still have access to all your cash and securities, as we will ensure that direct Drive Wealth access is established for you to continue to buy and sell securities. In the highly unlikely event that both Vested and Drive Wealth both shut down, your SPIC insurance kicks in. It's very similar to having an insurance on your fixed deposits or bank deposits. So SPIC insurance kicks in and each brokerage account opened with Vested is insured up to a sum of 500,000 US dollars. So in short, the process of buying securities in the US is slightly different compared to that how we buy securities in India. By securities, I mean stocks and bonds. Very different between India and the US. Important thing to note is that whichever app that you're using, whether you're using Vested, whether you're using some other party, Please understand that who the broker is. Check their registration. Please don't go and invest your money with unheard apps. Please don't do that. That can cause a lot of friction, lot of issues for you. Ensure that whichever broker or whichever investment advisory firm that you are engaging with in the US, they have SPIC insurance for your account also. So in the unlikely event that all the parties involved shut down, you still get your money. Very, very important concept. Now you'd say, Akshat, great, awesome. I understand why I should be making investments outside India. Number two, I'm gaining confidence that, hey, you know what? It's not as if that if I'm investing money outside India, I'll not get it. There are proper mechanisms ensured. There are proper regulatory framework. Third and finally, where do I get started? What are some of the key things that I need to get started on? I'll make a part 2 of this video if there is enough traction for it. If I get, let's say, 15,000 likes of this video, I will definitely make part 2. But I will leave you with some initial thought process around how to think about your US stock investing journey. First and foremost, you must have a very clear understanding as to what type of stocks do you want to invest outside India. For example, if you're buying HUL share in India, and similarly, if you're buying a similar company in the US, probably it would not make a lot of sense. On the flip side, if you have the story that, you know what, in India, tech companies will not become the next Google, Facebook, therefore I'm going to the US to invest, then probably it makes much more sense for you to go and explore those type of companies. Second, you must understand different options available to you in terms of sectoral split. For example, here are some of the prominent sectors in the US. First, there is tech sector, very easy for us to understand. Almost all of us who start investing in the US market, we are very fascinated by the US tech. So that's a very easy to understand sector. This will comprise of companies like Google, Facebook, and bunch of other renowned firms. Second part of this would be emerging tech. So here you will have companies like UiPath, Automation Anywhere, Coinbase, all these different types of companies are there. This is the second sector that you could consider. Third, there will be finance/banking sector. You have companies like JP Morgan, Goldman Sachs, Morgan Stanley. All these are very good companies. Fourth, there will be international listed companies in the US. For example, Alibaba is a Chinese company, but it is listed on US stock exchange. So that again becomes an important sector that you could consider diversifying into. Then there is a sector called as consumer staples. So these are everyday products. For example, McDonald's. People eat almost regularly, especially in the US. Then you have Walmart. So these are companies that generate regular cash flows. Companies like Coca-Cola. So these will be consumer staples, so to say. Stable cash flow businesses, you can definitely read more about it to build your understanding about US economy. Then you have some contentious sectors, for example, utility, right? You have energy. Now, these are high infrastructure cost driven businesses. So be very mindful in terms of investing in these type of sectors. It might not give you fruitful returns. And if you compare the index returns of, let's say, utilities to S&P 500, which is the index for the US, then the returns of utility/power sector has been very low compared to this. Then, of course, you have healthcare. Healthcare has been rising. It's a very prominent sector in the US. So you can start your research by understanding these different sector types. Now comes the final question that, Akshat, what is a sustainable return I can expect if I'm investing in the US economy or US market? So let's have a brief conversation about that. For example, if you're investing in S&P 500, which is the index for the US stock investing, then you can expect to make somewhere between 11 to 14% returns. Also, a very important point related to dividends, because in India, we get dividends directly into our accounts. What happens if you are investing via vested? Do you get dividends? Yes, you get dividends. There is absolutely no problem. How are dividends taxed? Your dividends are taxed in the US at 25% rate, and your profits are taxed in India. For example, if you have purchased Amazon and Amazon has given a dividend of $10, then that will be taxed at 25% in the US as per US tax laws. India has a double taxation avoidance agreement with the US. So in case you sell your Amazon stock, let's say that you purchased it at $100, you sold it at $120, and you made 20% gain within a year. So that will be taxed as per short-term capital gains tax in India, right? So that is the difference. This is a very important point. And the same thing plays out if you are undertaking your investment via vested. Do check the links in the description box. I have put in all the pieces of information together for you to take a look at. There is a special code also for you to avail a discount in case you want to open your account via vested. Do check it out. And if this video gets enough traction, then I'll shoot part 2. I will walk you through the entire process of buying a stock, researching a stock. So I will research an entire stock live in front of you and I'll make an investment in it, in the US stocks. So it will be a tutorial video. I'm planning on releasing it towards the end of the year, only if there is enough traction for this video. Thank you so much. I hope you enjoyed this video and I will see you the next time.